30-year fixed or ARM, adjustable rate mortgage? Which one will work well in the current interest rate environment? That's what we are going to discuss today. So, you must have heard me from my last week's video where I asked you as to where I was thinking through with you as to what should be your rate strategy, or how should you be buying your home, what kind of strategy should you apply. So I discussed down payment, adjusting the down payment, the effect of taxes to get the home value, the right amount of mortgage and the right kind of payment and all of those. But I did not discuss the difference between an ARM and fixed. I have been a very strong advocate of 30-year fixed mortgages. Right from the 4% that I saw in 2011, from then on, I have been advising my clients to get their 30-year fixed. So what is wrong with it? When you take a 30-year fixed and you refinance, you paid that higher interest rate for that much period while you refinanced, so that's a loss. Whereas if you were to do an ARM, what that does is you pay a lower interest rate, and then when you refinance that interest rate, you saved that difference between the interest rate that you are paying earlier versus later. So that's how that one works. Now, in the current interest rate environment, one of my clients recently got a 5.75 for a 7-year ARM. Now 5.75, when you hear 6 or 7% on the market from everywhere, is not bad. Like his best other option was 6.25%, which is a huge difference. 0.5% is a huge difference if you look at it. And so they got the 5.75. Now, with that kind of an interest rate, I would not recommend them to go for a 30-year fixed, because the 30-year fixed would be at 6.5 or so, which is 0.75 higher. So with that kind of a number, it becomes untenable to get a fixed rate mortgage. I have advised everybody to keep buying the 30-year fixed when the interest rate were in the 2s. And a lot of people, even that time, did a 7-year ARM. Not needless to say that those would repent today. But so in today's environment, we are likely to see a downturn. Now, what happens when you take an ARM versus a 30-year fixed? If you take a 30-year fixed and you sell your home in, say, 5 years, you unnecessarily paid that higher interest rate. A lot of people, they buy their home because their kids are going to a certain school and they want that school district. And once that need for school district is over, they move on. Or somebody bought their first condo or a townhouse when they did not have kids, and now in 5 or 7 years, their situation changed. They got 2 kids and they will move out. So when you do these things, the 30-year fixed is counterproductive. So it is very important to know your life stages, what you are planning to do, and how this is going to work. So that's one very important thing. But a 30-year fixed gives you that assurance that your monthly payment is going to be fixed for life until the mortgage gets paid off. And that's the peace of mind I want when I'm buying a property. But in today's market, I don't think the interest rate is going to stay this high. There will be some time when the interest rate is going to go down. And at that time, you are going to refinance. If you are going to refinance, this premium, if you were to get a 6.75% interest rate, when your going market rate is 5.75, you are paying on $1 million of a mortgage, you are paying $10,000 extra. That $10,000 is a huge number for every year to pay as a premium for a 30-year fixed. And so, in today's interest rate environment, you should probably not be thinking of a 30-year fixed. I have a lot of caveats though. I personally feel that given the current environment, the fact that the Moody's downgraded the US debt and we are off the rails just now in terms of the dollar depreciation and all that, probably you're not going to see that much funding come for the 30-year fixed product. And so the rates are going to keep going higher. So if you think that you are going to stay for a very long period in the property, or you are not going to pay off the mortgage that you borrowed, you should probably still buy a 30-year fixed. It seems high, but guess, the first $750,000 gives you the ability to write it down from your income. And so the federal tax break and the state tax break kind of eases that high interest that you feel it is. So think about it, and if you have questions, sure, write them down in the messages or feel free to pick up your phone and call me. I hope you enjoyed this video. Thanks for watching. See you on my next one.